As a general principle, following the crowd almost always works. For instance, if you see a dozen people standing in a line, then you're very likely to join them with the presumption that everyone knows why they are standing in that line. Now, from an investing standpoint, a good resemblance to this is an index fund, which in my opinion is the perfect herd following mentality with an increasing amount of money going to the same set of 50, 150, 250 stocks in more or less the same proportion irrespective of what the valuations are. But common sense tells us that one should do the exact opposite, that is, we should try to buy shares at the lowest price, because lower the price, the larger are the gains, and when we look at it a level down, a low price is only possible when other investors are selling that stock, which is exactly what the contrarian mindset is all about. So the quick and dirty definition of a contrarian is someone who opposes popular opinion, which basically means he or she is not doing what others are doing. As an investing strategy, this concept was born out of the majority's behavioral tendency of often underreacting and then overreacting to information, which consequently opens up a number of exploitable mispricings in the stock market. Now, the popular version of contrarian investing is that if everybody else is buying, then the contrarian thinks of selling and vice versa. Well, this is just one part of it, and it's definitely not some universal rule. However, what is indeed a fact is that a contrarian strategy is an excellent way of achieving strong risk-adjusted returns and also diversifying one's portfolio. If you want more information on the concept, the theory of it, then do check out this video's description for additional reading materials. But in this video, I shall focus on some practical stuff as we learn a bunch of strategies and techniques that are often employed by contrarian investors. If you like this video, then do give it a thumbs up. And because I have a very contrarian style of nudging for a subscription, please do subscribe. Let's begin. The first contrarian technique I came across is called the portfolio of losers, and in the most simple terms it involves intentionally investing in stocks that have performed poorly or have experienced significant price declines. Now the question is, when does a stock become a loser? And the most consensual definition I found was at least a 40% drop in the price of a stock. So if that's the definition, then over the last 1 year, we have companies like Adani Total Gas, Polyplex, Barbecue Nation, Balaji Amines, etc., which have seen a sharp drop in share price, while the Nifty went up by 11.5% during the same time period. Now, an analysis cited in the book Investment Fables by Professor Ashwath Damodaran suggests that if an investor were to buy the 35 biggest losers over the previous year and had held these stocks for the next 5 years, then he or she would have generated a cumulative excess returns of 30% over the broader market and an extra 40% when compared to an investment in the winner's portfolio. So obviously you and I have no interest in looking at the US data, and when I did this exercise for the Indian stock market, I took some assumptions. I pulled out the worst performing stocks for the last 2 years prior to August 2018, which then led me to this portfolio of 35 Indian stocks, which includes a lot of recognizable names. Now, as a portfolio, this list of 35 loser stocks over a 5-year period would have given me a CAGR of 91%. Yes, this is not a typo. This is actually 91% of analyzed returns, and a large part of it comes from 4 stocks, that is Orchid Pharma, Best AgroLife, Patanjali Foods, and finally Raj Rayon Industries, which by my assessment qualifies as a penny stock. Okay, when I knock off these outliers, so the top 4 and the bottom 4 performers, our revised portfolio of 27 losers still gives us a 5-year CAGR of 31%, while the Nifty during the same period grew by 11.7%. So that's an alpha of almost 20% every year for the last 5 years, and in numbers, this portfolio of say 1 lakh rupees in August of 2018 would have grown to almost 4 lakhs by now. Now remember, the professor also made a reference to a winner's portfolio. Well, that made me a little curious, and just like what I had done for the losers portfolio, I did it in reverse, and after removing the outliers, the 5-year CAGR of a 27 stock winners portfolio in the Indian stock market came to a much more placid 19%, which is still 8% more than the Nifty performance. So to put this all together, Loser's portfolio is based on a contrarian approach, and the strategy very clearly operates on the principle of going against the crowd. Number two, the implicit assumption here is that the stocks that have experienced a significant price decline may have actually been oversold due to negative news, market panic, or other short-term factors. Then there is the expectation that there will be a reversal of trends and these stocks will again become attractive to investors. And fourthly, if you want to create a 35 stock losers portfolio as of today, then per my estimate, these are the stocks that would be a part of it. The second contrarian strategy in our list is called a conviction change. And the only conviction you need to have is to trust what the equity analysts are recommending. Now, I haven't tried this technique myself, but a 2017 report by Motilal Oswal Securities says that if you invest in stocks where the analyst consensus has changed from a net sell to a net buy, so it's basically flipping the switch, then over a 1-year period, a portfolio of these stocks would have delivered an annual return of 24.1%. The team there analyzed this data over a 10-year period, and what the authors of that study are implying is that a change in consensus recommendations is a robust return predictor, as it contains a mixture of information that is not available in other predictive variables. Of course, before you start doing any of this, kindly verify these claims, because if an equity analyst is saying that the recommendations given by equity analysts are good, then I for one will go with my favorite Russian proverb that says, trust but verify. The next strategy, believe it or not, is actually based on human behavior and the fact that the mind cannot focus on too many things all at the same time. In the context of stock markets, it's often a few sectors that will soak in the limelight, while the other sectors rot in a pool of ignorance, although temporarily. In fact, this up and down cycle is something that we learned quite recently on my channel, and for the contrarian investor, these situations present massive opportunities. Take the pharmaceutical sector for instance, and for many years the Nifty Pharma had been operating at an average price earning multiple of around 40. But then from April of 2019, reports started rolling in of weakness in the US markets, regulatory issues, launch delays, pricing pressures, etc., which all did an incredible job of pushing down the index by a good 30%, and the P ratio dropped from 53 to a mere 24 within 6 months. Now, you and I don't need to be a contrarian to realize that when the pharma index P multiple goes into the early 20s, then the investor community as a whole, this majority is overstating the risk so much that investing into the pharma sector now no longer becomes a risky affair. I mean, it's the same lower the risk, higher the return gospel that I keep on repeating, but it's very clear in this case, isn't it? So we have a portfolio of pharma companies, and India is a big player in pharma. And when these companies are available to us at a discount of 30-40% of their usual earnings multiple, then not only does my risk of investing reduce, but it also means my chances of making a good return is a lot better. But to make the point even stronger, between March of 2019 and 2020, so that entire 1-year period, while the pharma index had gone down by 20%, its earnings per share had actually gone up by about 60%. So these are the kind of opportunities that a contrarian keeps an eye for, and since every sector, every industry goes through a business cycle, it isn't very difficult to spot them. Another commonly used contrarian strategy is to invest in something that others are not looking at. A good example of that is Eicher Motors, and between 2004 and 2010, when it sold 13 of its 15 businesses, I'm sure a lot of people might have wondered if the company would even survive. But a contrarian's viewpoint is a lot different, and he or she would have probably seen a more focused company with a leaner structure, a growing demand for retro-styled motorcycles, improving operational efficiency, and a promoter who can be best described as an intelligent fanatic iconoclast. And I hope everyone reads the Sanjay Bakshi article that I have linked in the video's description. My point is, contrarian investing is about challenging conventional market sentiments, and what also qualifies as contrarian investing are early investments in growth companies when they are under-owned and underappreciated, the spotting of emerging trends, and although it can be a bit risky, the rewards can be substantial, and also when great businesses are going through a temporary lean patch or if they have been hit by some negative news. Okay, now if you don't want to do any of what I've said so far, then there is always a mutual fund that can come to your rescue. Now, generally, Contra and value funds are bunched together, but if I were to extract the three funds that have the term Contra in them, then on a performance basis, these funds have definitely done better than most index funds, and they can also be strong challengers to even flexicap and multicap funds. So all this is good news, but when we look deeper into these funds, what might surprise you is that all funds except maybe SBI Contra are holding over 70% of their assets in large cap companies like HDFC Bank, Infosys, Reliance and ICICI Bank, and I'm not sure what degree of contrarian investing is visible here. Another weird observation is on the number of constituents, with all three schemes having 59 or more stocks in its portfolio. This sort of makes me think, how different is this actively managed Contra fund to maybe a large and mid cap or even a flexi cap fund. So there is some dissonance in my head, and as it happens in Contra, where a two-player game is a lot more fun, thankfully I have Fisdom and its wonderful research team to bank upon, who have created this detailed report on how Contra mutual funds are playing out and how the category is poised. This report consists of many big and small details, including a comparison of different Contra funds, Fisdom's research rating for each of the schemes, how is this category different from other equity MF categories, and of course the team's take on whether Contra funds deserve a place in your portfolio or not. A copy of this report is available in this video's description, and I sincerely hope you make good use of it. Picking stocks with a high dividend yield is yet another strategy that comes from the Contrarian investing toolkit. You might have even heard of a dogs of the Dow strategy, which is about investing in the 10 highest yielding dividend stocks of the Dow Jones Industrial Average. The thought process here is that these stocks might be temporarily undervalued, which can lead to potentially attractive returns through a combination of dividend income and price appreciation. Now, the Indian variant of this, when layered over the Nifty 200, would include companies like Coal India, ONGC, Indus Towers, Vedanta, Oracle Financial Services, etc., each of which presently offers a dividend yield of over 5%. So what is typically seen with this dividend yield strategy is that one would generally be investing in utilities or in distressed sort of companies which have a low P ratio and a low price to book ratio. But then many of these companies generally struggle for revenue growth, and some of them might have delivered even negative stock price returns over a 5-year period. Personally, it's not a strategy I prefer and would instead lean more towards the dividend grower strategy, which we have discussed at length in my video on dividend aristocrats. The country of Peru went through a period of economic stagnation throughout the 1980s, which is often called Peru's lost decade. But for a contrarian like Sir John Templeton, this presented a glorious investing opportunity, as he invested quite a bit in 1985 at a time when the combined value of all Peruvian stocks was less than $400 million. You see, Templeton logically figured that the country was at its point of maximum pessimism and that there was a lot of upside from that particular point, which is exactly what happened. And over the next 10 years, the Peruvian economy rapidly recovered and the stock market index rose by 140 times, computing to an annual return of 83%. We saw something similar during the COVID years, with airline stocks and also hotel stocks facing significant declines due to travel restrictions. But as the restrictions eased and demand picked up, these sectors rebounded and some investors made a killing. My point is, when it comes to investing, and especially from a contrarian's viewpoint, start looking at pessimism as a friend and euphoria as your enemy. The use of metrics and a screener is a very common way of selecting stocks, and we're always trying to differentiate between the expensive and the relatively cheaper stocks. This requires us to look at metrics like the price earning multiple, the PEG ratio, which is something we learned in that video on Peter Lynch, the price to book value, EV on EBITDA, and a few more. Now, it's a common misconception that a contrarian would only invest in stocks that are at a low P ratio, and that's where the understanding of a cheap company and an undervalued company is very important. So a cheap company is one that would have everything you're looking for from a metrics perspective. That is a low P ratio, a high dividend yield, a low price to book ratio, and it's very likely that this cheap company will continue to remain cheap all its life. On the other hand, an undervalued opportunity would present itself as a great business which is probably going through some tailwinds, like what Infosys went through in 2016 or Maruti Suzuki in 2018. Both these companies recovered, regained their momentum, which then led to substantial returns for the contrarian investor. The point is, investing on temporary setbacks in a great business is a far better strategy as compared to looking at businesses that are permanently cheap. Right, so point blank, if you want to beat the market, if you want to beat the Nifty 50, then you have to be a contrarian in some capacity, which would require a combination of patience, discipline, conviction, and of course, superior research. That's the final point I want to drive in this video, and as you look at more scenarios, as you continue to hone up your skills, one would start deriving the big benefits of a contrarian strategy, which amongst other things includes a higher portfolio return, a reduction in volatility, less overreaction to market developments, and better diversification. I sincerely hope you found this video informative and useful. And if you learned something today, then do tap that like button, do invite your friends to subscribe to my channel. And as always, I'll see you 3 days from now. Until then.